Hi, I'm James Daniel and welcome to Personal Finance FYI, the web program designed to help you make smart financial decisions and to grow your wealth. They say there are only two things certain in life, death and taxes. And today we're going to talk about the more pleasant of the two, death. Nah, just kidding. Today we're going to talk taxes. Now I understand that you'd probably rather spend the next few minutes doing anything but discussing taxes. However, if you hang with me through this broadcast, I promise to share with you a few things that you can do to lower the amount of taxes you pay, so that means more money in your pocket and less in Uncle Sam's. And better yet, I'll show you how you can use this tax knowledge to get a brand new electric vehicle at a huge discount. Let's start with the 1040. This is the standard two-page document that you file by April 15th every year. The top of the form is simply your personal information along with your spouse, and in the middle you list any dependents. Notice right in the middle of the number of exemptions box. This is important because for you, your spouse, your dependents, you get one exemption for each, and that translates into deductions, which means a lower tax bill. In the lower half of that first page, you list all your sources of income, starting with your wages as reported on Form W-2 by your employer. Income is a great thing, except when the tax bill is due. As the lower this number is to begin with, the lower your tax bill will be. The first thing you can do to lower that W-2 income is to make sure you're taking advantage of pre-tax savings tools through your employer, like a 401k, a flex spending account, and even a dependent care account if you're eligible. The lower half of this page is simply adjustments to your income that will help lower your overall income from above. Certain things can come right off the top line, such as qualified moving expenses, IRA deductions, and student loan interest deductions. Once again, these are things that lower your gross income, which means lower taxes. With that in mind, before we jump over to page 2 of the 1040, let's stop for a minute and discuss two major things that lower your tax liability: deductions and credits. Deductions are things that can lower your gross income so that you owe less tax. Credits are even better, since they're a dollar for dollar reduction in the tax you owe. On the bottom of the page 1, we discuss several deductions that can lower your adjusted gross income. That's the number arrived at the bottom here. When we jump to page 2, we get to continue lowering that number, first with what is called a standard or itemized deduction. A standard deduction simply means you get to subtract one lump sum from your gross income, and currently that is $6,100 if you're single and $12,200 if you're married. This is good as it continues to lower that overall income, which means less tax. But there's also the option to skip the lump sum standard deduction and itemize your deduction instead. Why would you want to do this? There are certain deductible items that you get to calculate on a form called Schedule A. Things like mortgage interest, health care expenses, and charitable donations, just to name a few. If all of these add up to more than the standard deduction, then you would choose to itemize and knock down that gross income number even more. This, of course, has been followed by exemptions on line 42. Remember, from the first page, I mentioned that you get an exemption for you, your spouse, and your dependents. This means another $3,900 subtracted off of your gross income for each of those dependents. Not bad, as it keeps lowering that income number. And remember that to pay less tax, the objective is to keep knocking that income number lower. So now we have deducted everything that we can and arrive at line 44, which is your tax. Not a fun number to look at, but now comes the good part: tax credits. Remember that the credits are a dollar for dollar reduction in the tax owed. Line 47 through 53 are the bulk of the allowable tax credits, with a few more toward the bottom of the page. When we come back, I'll go over a few of the credits that you can take advantage of this year. So let's talk about some of these tax credits that you might be eligible for. First, there's the child and dependent care credits. This piggybacks the exemption you get for a child, but actually gives you a tax credit. There's education credits, both a lifetime learning credit and American Opportunity Credit. Both are programs that might save you a few tax dollars, and they're both related to higher learning and are completely separate from the student interest deductions on the first page of the 1040. There's the Retirement Savers Credit, and this is a credit for actually contributing to a retirement plan. There's the Premium Credit, and this is a subsidy you would get for health insurance on the exchanges. And then there's the Residential Energy Credit. This one gave you a credit based on the installation of energy-efficient devices in your home. Officially, it is in limbo until Congress makes a decision about extending it or not. And lastly, I teased you about getting a brand new electric vehicle at a fairly substantial discount earlier. This is all with the help of tax credits. Much like the tax credits for your home, there are both federal and state tax credits for the purchase of an energy-efficient vehicle. Currently, there are up to $7,500 in federal tax credits, and here in Georgia, there's $5,000 in state tax credits for the purchase of an energy-efficient electric vehicle. Remember that a credit is a dollar-for-dollar reduction in taxes owed, so it's basically like cash. If you bought an electric car, let's just say a Nissan Leaf, for $30,000 and managed to get all $12,500 in tax credits, that ends up being a pretty sweet deal. Of course, this is just a generic example, and you need to do your own due diligence before acting on this, as there are a lot of rules and regs to qualify. Hopefully today simplified the tax return a bit for you and gave you some ideas on how to save money on your taxes in the future. As always, none of this should be considered tax advice, and you should consult a tax pro before acting on any of these strategies. I'm James Daniel, and I'll see you on the next episode of Personal Finance FYI.